So there's been quite a bit of talk and controversy lately in the news, specifically dealing with the coronavirus and especially with the elections coming up and everything. And I kind of wanted to just touch on a couple of financial points, and in particular some issues that I've seen that were probably not the best advice when it comes to dealing with your money. The first issue has to do with what we're actually dealing with right now, which is a stock market correction, or in particular what's called a market drawdown. And what we've been noticing is that for the last few months, the stock market has been generally trending upwards. But the last couple weeks, it had a pretty big dip. I'm exaggerating with this drawing. And now it's kind of coming back up a little bit. This dip, which is basically the height difference, say between here to here, that little height difference right there. And the other thing that's important is to take a note of how long it took, say from that time to that time. So there was some kind of, change in time, and there was some kind of change in, say, height, or basically the change in price, basically. That change in price or that drop over that time frame is called a drawdown. One of the pieces of advice that I've heard, say, over the last several months or even last couple of years when the market was doing well was to have your emergency fund invested in some kind of an investment tool, like maybe, say, like the stock market or maybe even real estate. And while it's easy to say that kind of stuff when the markets are doing well and everyone has a job and they're bringing in money, it's when you have a drawdown, that's when you actually challenge this perception. Let's say, for example, that you had a fully funded emergency fund and you had $30,000 in there, and because you read online somewhere or because someone told you that it would be a really good idea to have that money invested, because if you just had it sitting around in a savings account, it would be earning nothing and inflation would be eroding away. But just in the last week, the stock market had one of its biggest drawdowns since 2008 of around 10%. That 10% would result in a reduction of the emergency fund by $3,000. And based off conversations I've had with a lot of you folks, and especially with conversations on TikTok, $3,000 for a lot of people is a whole month's worth of expenses. So you can probably imagine just how terrifying it would be that just within a week's time frame, you end up losing a month's worth of expenses just like that without you even having to have done anything. And the problem is that this emergency fund is supposed to be your rock, the solid foundation that is supposed to protect you when times are down, such as when the market starts going down. And it just evaporated and lost a month's worth nearly of your expenses. Other things to consider when it comes to investing your emergency fund is that it actually takes time to sell shares, because these are actual trades happening on the New York Stock Exchange. So your emergency better not happen when the stock market is closed, like on weekends or on holidays, because you won't be able to have any access to your money before then. Another issue that I've noticed is there's some folks out there that are encouraging others to keep a certain amount of money set aside in, say, a savings account, so that this way they can take advantage of, say, when the stock market does dip, like it's been doing. This is kind of known as buying the dip, or essentially it's just timing the market.
Right, this is a game that I found that just kind of shows you just that how poorly you are at supposedly at trying to time the market. So it gives you $10,000, and you're supposed to hit sell when you think it's high, and you hit buy when you think it's low, and they give you $10,000. So, and it picks a random 10-year timing in the market. So let's hit start. Let's see how well I can do. Let's see. I want to sell when it's high. It's going up. Ooh. No, oh, shoot, wait. Come on, get up there, get up there, get up there. Get up, get up, get up. Go. Let's try there. Nuts, missed it. Alright, let's keep going. I want to buy when it's oh, crud. Ooh, buy. I kind of bought it a little bit at a little bit of a dip, but I'm not sure how well that's gonna work out for me. Let's see. Here's my account balance. Yeah, all it says I can do now is just write everything out. So hopefully it's not gonna be too bad. And I didn't beat the market. So let me try again. Try again. Okay, here we go. Let's see. Alrighty. Ooh, we're going up. We're going up. Ooh, oh, shoot. No. Alright, sell. see. Oh, bot. Oh, there we go. I don't know how well I'm going to do right there. But I mean, the thing is like, see, this is why it's so ridiculous to try to time the market. Because if you have the money set aside, you're better off just trying to put your money in and just let it ride, instead of trying to time everything. That's a matter of just letting it ride out. Let's see. We did pretty good at the end. Oh, I actually beat the market. Woohoo! But not by much.
When it comes to expenses and budgeting, I think a lot of times, and I even said this and do this a lot of times myself, is it's easy to say to go ahead and cut expenditures so that this way you can ultimately end up increase your cash flow, which gives you more money throughout the month that you can now use for whatever your money goals are. So this is the cash flow equation, which is the difference between income and expenses. And if I want to raise my cash flow, I have two options. I can raise my income, always a good option, or I can lower my monthly expenses. And I think I figured out why people really don't like budgeting. And they don't even like the word budget, because they always focus on this part right here, this reducing E. And people always interpret it as, oh, that means I can't get to do what I want to do. I can't go out to the places I want to go out. I can't eat the foods that I want to eat. I can't go to parties, or I can't enjoy myself. I can't, spend a day with friends or whatever and spend money here. Or I can't do this, or I can't do that, or I can't travel. That is not what this means, and at least not initially. So let me clarify this. So if you are underwater financially, and by that I mean you're not debt-free and you don't have an emergency fund, the first goal is to get above water and at least start getting some air so you have some breathing room. And this should be paramount to anything else that you do. So this is why when it comes to reducing expenses, this is where you like Dave Ramsey says, you don't see the inside of a restaurant unless you work in one. You're selling everything that you can to bring everything to get your money back up to where it needs to be. I think there was a CNBC Money video that was done several months ago. I did a reaction video to it about how you shouldn't be doing budgeting, and I completely disagree with that. But one of the examples in there that they showed was a bunch of, I guess, millennials and stuff that were spending about $100 a month on their coffee. Now, I railed about that because that was basically $1,200 per year that these folks were quite literally pissing away, as opposed to having that money work for them. And normally the budgeting or the optimizing cash flow example would say to reduce that $100 in coffee. But I want to reevaluate this situation and kind of give it a different perspective on probably a better approach, as opposed to just cutting out the coffee and whatever you love. So there's two main points that I want to touch on. The first is what I'll just call proper budgeting. And what this means is that budgeting doesn't mean that you are constantly restricting and removing things that you love and enjoy in your life. What it means is a redistribution of the funds so that this way you can afford what you love, and let's say you cut back on things that you don't really love. So let's say that the reason why you're actually spending $100 per month is because you're going to Starbucks every morning and you're ordering the venti, mocha, latte, frappa, cupless, whatever that you're getting, and that's why it's actually so expensive, which might end up being around $5, $6, $7 per cup. You love coffee and you love starting your day off with it, but let's just say that it's really not the mocha, latte, frappa, whatever that actually is what you're interested in, but rather the caffeine hit early in the morning. Because if it's just the caffeine hit, you can go to Walmart, pick yourself up a Mr. Coffee for 30 bucks and make a cup of coffee every morning for 60, 70 cents, get your caffeine fix, and not have to spend $100. But let's go ahead and say that it is the mocha, frappa, latte, venti, whatever, and that is actually what you really love, and you love getting that every morning. There actually is a way of handling this. Instead of, say, reducing your expenditures or cutting that out of your life because you actually enjoy it, what you could do is instead redirect the extra $100. So let's say you have one expense, let's say expense, I don't know, A, I don't want to use numbers. And let's say you have another expense, say expense B, and another expense, expense C, right? And this could be eating out, this could be your coffee, this could be clothes shopping, whatever it is, plus dot, dot, dot. And all of this combined creates all of your expenses that you have for the month. What you could do is, let's say here's your expenses for coffee, right? This is one right here. All right, we want to basically raise this. It's okay to raise an expense so long as other expenses can go down a little bit in proportion. So if I want to raise this expense by $100 for my $100 of coffee, let's say we avoid eating out, say by $50 a month. We drop this. And let's say we drop, I don't know, maybe trips to the fun zone or whatever it is that you might end up going by, say $50 or something like that. Or you go every other month or something like that. And the reason why I say eating out and like say the fun zone or whatever it is these would be things that you enjoy, but you enjoy coffee more. So direct more funds into that. You can raise that expense all you want, so long as the net cash flow doesn't end up going down as a result of you spending more money in one particular category throughout the month. The other concept is what I would consider asset cash flow, and this comes from the net worth equation. Put that right here, where what you own minus what you owe, and assuming you have zero debt because you have zero liabilities, it's all about what you own, and you take your assets, and the assets will provide the income necessary to pay for whatever it is that you want to pay for. So the question then becomes, what asset value A, and let's say you're going at around a 4% dividend yield, we'll use dividends as an example here, will end up equaling, and $100 a month, that would be $1,200 per year. Right? So because we're looking at a per year here, and this is called an AP, generally an APY, which is an annual percent yield. So we have annual and year, so we're in the same time frames. Solve for A. The asset value turns out to be around $30,000, but let's just go ahead and bump that up to around $32,000 just to take care of taxes. If you invested a principal of around $32,000 at around a 4% dividend yield, that would end up paying about $100 a month in dividends, which you could then use to buy your $100 a month in coffee. And the reason why this is so important is because you're not touching any of the principal, you're only using the interest. And the money that comes off of this asset is money that you didn't have to work for, you didn't have to trade your time for or anything. It's money that your money earned. So with a combination of budgeting correctly and adjusting your expenses so you don't lose cash flow, and by having a particular asset in place, you can essentially have free coffee for life while maintaining a proper cash flow and still building wealth. So happened that I think it was about 3 weeks ago, that I ended up starting an M1 finance account. In particular, it was an M1 dividend, or particularly a investment that was focused on income. And that portfolio was specifically designed to show folks over on TikTok how to start investing, how to open up an account, and how to really start evaluating like companies and getting their portfolios going. So this way they're not sitting on the sidelines and waiting for whatever to magically happen. Just so happened, like the day after I funded that account and money was actually in there and I allocated all of my all the weightings for the different stocks and everything, the entire market just took a major sink. And it was really actually a great opportunity to show that this is what ends up happening when you're doing investing. Markets are going to tank, and it's not a time to panic, but actually a time to just keep going, make sure you know the goals, make sure that your investment portfolio has a particular goal in mind, and to keep putting funds and assets in there to support that goal. Because this account is so brand new, it's only a few weeks old, what I'm going to do is actually show, I think, as a weekly update, how the account is doing, what my investing philosophy is, why I've chosen certain funds that I've chosen, what tools that I use, the strategies that I use. I'll tell you, if I buy anything, if I sell anything, and why. This way to kind of give just more of an example to show what it looks like, first of all, when you're starting out brand new. Because I started this account with just $100, which was the bare minimum, coincidentally because we're saving for a house and we're directing all extra cash flow into that account, but also because this kind of represents what the TikTok audience is kind of capable of doing. Having $100 a month, or having $100 to start out, and investing, and that's the other thing, I'm going to be investing $25 per week. So this way I can do weekly updates with them and show them how all that works. But then I'll also be able to show everyone here on the YouTube community what the investments are, how I allocate things, what sectors I add, what new slices of the pie that I add, and everything. And this is going to be, like I said, this is a brand new portfolio. So I will go ahead and show you that right now.
So this is my M1 dividend the dividend portfolio. As you can see, the market is down a little bit, but these are the slices of the pie. And you can see under activity, so far I put in just $125. 100 was the initial, and 25 is, just for, I think it was last week. But to give you a quick little tour of this little guy, I have these are all the different slices. So real estate, I have money in what's called Realty Income Corporation. And then if I look under the financial sector, I have Main Street Capital. They pay dividends as well. Healthcare, also down. This is Johnson & Johnson, 100% in Johnson & Johnson. I'll be adding more to these later on. If I go to consumer, I have 3M and Coke. These are both two really good dividend-paying companies. And then there's some bonds in here. This is just kind of be a little bit more defensive and level things out a bit. I have these, the iShares, iBox investment grade bonds. This kind of helps level things out just a little bit. And then finally, under utilities, I have Dominion Energy. So I'll do, like I said, weekly updates with this. Overall, it's kind of down. Let's see. The last day it was kind of up a little bit. And for the week, it's been down. But this is, again, I'll just kind of show you updates on this and go over my investing strategies and kind of just give an overall update on how this is doing on a weekly basis.
I think it'd be really cool to see this thing start from basically the ground up and start with very little investments so that you can see that even with $25 a week, which will end up being about $1,300 a year, at least until we can buy a house and start adding some extra money to it, that it's going to still make some significant strides, as well as give me an opportunity to show how I do my investing and what my investing strategy is, particularly when it comes to an investment or particularly when it comes to an income investment portfolio. So, as always, thanks for watching and have a great weekend.